At 40, many high earners in tech and finance are still significantly behind. The average 40-year-old should have around 3 times their annual salary saved for retirement. Are you there? Consider this: if you plan for a $100,000 annual retirement income for 25 years, you'll need $2.5 million, conservatively. Have you run these numbers yet? Delaying serious retirement planning until 40 means you've potentially missed decades of compounding. Every year past 30 costs you hundreds of thousands in growth. Financial advisors often recommend having 1 year's salary saved by 30, 3 by 40, 6 by 50, and 8 to 10 by retirement. This is your baseline. However, the average 40-year-old American has only about $120,000 in retirement savings. This is significantly below the 3x salary benchmark for most. For someone earning $150,000 annually, the benchmark is $450,000 by 40. $120,000 average means a $330,000 gap exists. That's substantial. This gap isn't just a number, it translates to a significant downgrade in your potential retirement lifestyle or years added to your working life. It's a critical reality check. Remember, inflation erodes purchasing power. $1 million today won't buy the same in 25 years. Factor in a 3% inflation rate for long-term planning. And don't forget healthcare. A couple retiring at 65 today may need over $300,000 for medical expenses throughout retirement, excluding long-term care. So what's your number? How much do you actually need? Use a reliable retirement calculator. It's the first step to truly understanding your position. Let's talk compounding. Investor A starts at 25, investing $500 monthly. Investor B starts at 40, investing $1,000 monthly. Who ends up with more? Assuming a 7% annual return, Investor A, with less total contribution, could reach $1 to the millers by 65. Investor B, despite double the monthly, only reaches $550,000. That's the exponential magic of time. Those extra 15 years for Investor A meant their money worked harder, longer, generating wealth on top of wealth. If you're 40 and just starting a serious $1,000 monthly contribution, you've effectively lost approximately $650,000 in potential growth compared to starting at 25. To catch up to Investor A's $2,000 millions by 65, Investor B would need to contribute nearly $2,200 monthly from 40. That's a significant burden. This increased contribution means sacrificing current lifestyle choices, fewer vacations, delaying home improvements, or cutting discretionary spending. It's a direct trade-off. Or you simply work longer. Instead of retiring at 65, you might need to work until 70 or even 75 to accumulate enough wealth. Is that your ideal retirement? Consider your energy and health at 70. Will you have the same capacity to enjoy retirement activities if you're forced to work longer? Time is more than just money. Delaying retirement can also impact Social Security. While claiming later increases benefits, needing to work past full retirement age due to lack of savings isn't by choice. With less time, your investment strategy often becomes more conservative, limiting potential higher returns. You lose the luxury of riding out market volatility. Financial stress is a real burden. Constantly worrying about your retirement future impacts your present well-being. Proactive planning reduces this stress. Your financial security impacts your family. Without proper planning, you might become a financial burden on your children or unable to support them later. Beyond retirement, a strong financial base opens doors: early semi-retirement, pursuing passions, or leaving a legacy. Delay closes these doors. At 40, you're at a critical inflection point. The window for maximum compounding is closing. Every month counts more than it did a decade ago. You have less margin for error. Market downturns or personal financial setbacks become far more impactful when you have fewer years to recover. First, accurately assess your current net worth and retirement savings. Get a clear picture of exactly where you stand against industry benchmarks. Next, use a robust retirement calculator to project your future. Input different scenarios: increased contributions, delayed retirement, varying returns. Then, optimize your investment strategy. Consider increasing your 401k/IRA contributions to the maximum. Explore Roth options or a backdoor Roth for tax efficiency. Finally, don't go it alone. Consult a fee-only financial advisor. Their expertise can uncover overlooked opportunities and create a personalized roadmap for your unique situation. Welcome back. While Chapter 1 focused on retirement gaps, Chapter 2 is about securing your present and future. We'll optimize debt, protect assets, and ensure your family's financial resilience. Our goal is a robust financial foundation. This means strategically tackling high-interest consumer debt, establishing comprehensive estate plans, and securing adequate life insurance. Let's get optimized. First, high-interest consumer debt. Credit card balances averaging 20% APRA can erode wealth faster than investments grow. Prioritizing these is paramount for financial stability. Identify your highest APRA debts. List them all, from credit cards to personal loans. A $10,000 balance at 20% APRA costs $2,000 annually in interest alone. That's real money. Adopt the debt avalanche method. Pay minimums on all debts, then direct any extra funds to the one with the highest interest rate. This minimizes total interest paid over time. Consider debt consolidation. A personal loan with a lower, fixed interest rate can streamline payments and reduce overall cost. For example, consolidating 3 credit cards at 20% into one 8% loan. Negotiate with creditors. Many are willing to work with you, offering reduced interest rates or payment plans, especially if you're proactive. A simple call can save hundreds. Reallocate your budget. Find an extra $100, $200 per month to accelerate debt payments. This isn't just about saving interest, it's about reclaiming financial freedom faster. Next, let's talk about protecting your assets and legacy. Estate planning isn't just for the ultra-wealthy. It's crucial for every family to ensure their wishes are honored. A comprehensive will is foundational. It dictates asset distribution, names guardians for minor children, and appoints an executor. Without one, the state decides, which rarely aligns with your intent. Trusts can offer more control and bypass probate. A revocable living trust allows you to manage assets during your lifetime and transfer them privately upon death, avoiding costly delays. Beyond wills and trusts, consider powers of attorney. A durable power of attorney for finances allows someone to manage your money if you become incapacitated. A medical POA designates healthcare decisions. Review your beneficiary designations on all accounts ERA, 401ks, and life insurance. These supersede your will. An outdated beneficiary can lead to unintended asset distribution. Engage an estate planning attorney. While online tools exist, a professional ensures your plan is legally sound, tax-efficient, and tailored to your unique family dynamics and wealth goals. An optimized estate plan isn't a one-time setup. Review it every 3-5 years or after significant life events like marriage, divorce, birth of a child, or a major inheritance. Stay current. Finally, let's talk about life insurance. It's not about you, it's about protecting your loved ones financially if the unexpected happens. It's a critical safety net for families. How much coverage do you need? Use the DIME method: debt, income, mortgage, education. Sum these up to get a baseline. For example, $50 K debt plus $500 K income 10x plus $300 K mortgage plus $150 K education equals $1 M plus. Term life insurance is often the most cost-effective. It covers you for a specific period, typically 10, 20, or 30 years, aligning with your peak financial responsibilities. It's pure protection. Whole life insurance, while offering lifelong coverage and a cash value component, is significantly more expensive. Understand its complexities and whether it truly aligns with your long-term wealth strategy. Don't forget riders. A waiver of premium rider keeps your policy active if you become disabled. A guaranteed insurability rider allows you to increase coverage later without a new medical exam. Review your life insurance coverage annually. Life changes, new dependents, increased income, or a paid-off mortgage can alter your needs. Ensure your policy still aligns with your family's current situation. Remember, life insurance benefits are generally income tax-free for beneficiaries. This is a significant advantage, ensuring your family receives the full intended financial support without tax erosion. Consider group life insurance through your employer. It's often affordable, but typically insufficient as primary coverage. Supplement it with an individual policy to meet your full DIME needs. Work with an independent insurance agent. They can compare quotes from multiple carriers, finding the best rates and policies tailored to your specific health profile and financial goals. Remember, protecting your family's financial future is a continuous process. Debt management, estate planning, and life insurance are interconnected pillars of a robust strategy. Take action, list your debts, Schedule A will review, and calculate your dime life insurance needs. These steps are not for tomorrow, they're for optimizing your financial health today. By tackling these areas, you're building a fortress around your family's wealth. This proactive approach minimizes risks and maximizes security, setting the stage for future growth. Remember, the optimized path isn't the fastest, but it's the most sustainable. Slow and steady wins the race, especially in the marathon of financial planning. Stay chill, stay strategic. In Chapter 3, we'll shift our focus to maximizing investment returns and optimizing tax strategies. Join me as we explore smart asset allocation and advanced tax efficiency. Welcome back, financial trailblazers. Today, we're sharpening our focus on optimizing asset growth. Our journey begins with a fundamental question: should you prioritize saving for your retirement or your child's education? The simple answer, often overlooked, is retirement. You can secure loans for education, but there are no loans for retirement. Your future self depends on your disciplined planning now. Your first step: maximize your employer's 401k match. If they offer a 50% match up to 6% of your salary, that's an immediate, guaranteed 50% return on your contribution. Don't leave free money on the table. Consider the power of compounding. A $10,000 investment at age 30, earning 7% annually, could grow to over $150,000 by age 70. That same $10,000 at age 40, only around $76,000. Time is your greatest ally. Once your retirement is on track with employer matches and solid contributions, then consider a 529 plan for education. These plans offer tax-free growth and withdrawals for qualified educational expenses. Many states offer tax deductions or credits for 529 contributions. For example, New York offers a $5,000 deduction for single filers, $10,000 for married. Research your state-specific benefits. Remember, excess 529 funds can now be rolled into a Roth IRA for the beneficiary, up to lifetime limits. This adds flexibility, mitigating the "what if they don't go to college" concern. Moving on to another optimization challenge: is it better to aggressively pay down your low-interest mortgage or invest that extra capital? This often depends on your risk tolerance and market outlook. If your mortgage rate is, say, 3.5%, and historical market returns average 7–10%, mathematically, investing often yields higher returns. You're effectively earning the difference. However, paying off your mortgage offers guaranteed, tax-free returns equal to your interest rate. It's a psychological win and reduces financial stress, a valuable, albeit unquantifiable, benefit. Also, consider the tax deductibility of mortgage interest. For many, this effectively lowers the true cost of borrowing, making the investment argument even stronger. Your decision should align with your financial goals and risk tolerance. If market volatility keeps you up at night, the peace of mind from a paid-off home might outweigh potential investment gains. For most, a balanced approach works best: contribute enough to retirement, then perhaps make extra payments to mortgage principal if it feels right, while still investing consistently. Now, let's maximize those tax-advantaged retirement contributions. This is where strategic planning truly pays off. First, fully fund your 401k up to the maximum annual limit. For 2024, that's $23,000 or $30,500 if you're 50 or older, thanks to catch-up contributions. These pre-tax contributions reduce your taxable income now, offering immediate savings. Next, fully fund your individual retirement account IRA. For 2024, that's $7,000 or $8,000 if you're 50 or older. You have the choice of traditional or Roth. Traditional IRAs offer tax deductions now, but withdrawals are taxed in retirement. Roth IRAs are funded with after-tax dollars, but qualified withdrawals in retirement are completely tax-free. If you're a high-income earner above Roth IRA income limits, explore the backdoor Roth strategy. This involves contributing to a non-deductible traditional IRA and then converting it to a Roth. Another advanced technique is the mega backdoor Roth if your 401k allows after-tax contributions. You contribute after-tax funds, then convert them to a Roth IRA, significantly boosting your Roth savings. Don't forget the Health Savings Account HSA if you have a high-deductible health plan. It's often called the Triple Tax Advantaged Account tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. HSAs are also portable and can be invested. If you don't use the funds for medical expenses now, they can act as an additional retirement account later, especially after age 65. For the self-employed, consider a SEP IRA or solo 401k. These allow for much higher contribution limits than a traditional IRA, significantly boosting your tax-advantaged retirement savings. A solo 401k allows you to contribute both as an employee and an employer, potentially reaching limits upwards of $69,000 for 2024, plus catch-up contributions if applicable. Another crucial concept is asset location. This means strategically placing different types of investments in different account types to maximize tax efficiency. For instance, highly taxed assets like rate or actively managed funds might be better suited for tax-advantaged accounts like a 401k or IRA to shield their income from immediate taxation. Conversely, low-turnover, tax-efficient investments like broad market index funds are often ideal for taxable brokerage accounts, where capital gains are only realized upon sale. Regularly review your asset location strategy as your investment portfolio grows and tax laws evolve. This isn't a set-it-and-forget-it task. It requires periodic optimization. By intelligently prioritizing your retirement over education, making informed mortgage decisions, and leveraging tax-advantaged accounts, you're building a robust foundation for lasting wealth. These deliberate choices aren't about quick wins, but about sustainable, optimized growth. Stay calm, stay strategic, and watch your wealth compound. See you in the next chapter. We've journeyed from financial awakening, through debt restructuring and asset protection, to optimizing growth. Now, in our final chapter, we cement long-term stability and true financial self-sufficiency. Today, we'll master dynamic portfolio allocation, ensuring your retirement savings always align with your life stage and risk tolerance. This isn't a set-it-and-forget-it, it's a set-it-and-tweak-it strategy. Your 20s and 30s. Aggressive growth is key. Consider an 80-90% equity allocation. For example, a 25-year-old might target 85% stocks, 15% bonds, maximizing compound growth over decades. In your 40s, as retirement looms closer, gradually reduce risk. A 70% equity, 30% bond split might be appropriate. This protects accumulated gains while still seeking growth. Approaching retirement in your 50s and early 60s, capital preservation becomes paramount. A 50/50th or even 40/60th stock to bond ratio minimizes volatility, safeguarding your nest egg. Remember the rule of 110? Subtract your age from 110 to get your approximate stock allocation percentage. So, a 50-year-old might target 60% stocks, 110/50 equals 60. Beyond age, your personal risk tolerance and financial goals dictate your allocation. If market dips cause sleepless nights, a more conservative approach, even if younger, is wise. Rebalancing is crucial. Annually, review your portfolio. If stocks surged, you might be 80/20th instead of 70/30th. Sell some winners, buy some underperformers, bringing you back to target. This is discipline. Rebalancing reduces overall risk and forces you to buy low, sell high systematically. Automate this if possible through target date funds or robo-advisors like Betterment or Wealthfront. Now, let's talk automation for consistency. Set up automatic transfers to your 401k and brokerage accounts. Even $50 weekly adds up significantly over time. Automate your savings for specific goals too. Designate $200 monthly for a down payment fund or $100 for a child's 529 plan. This removes the decision-making friction. Many banks offer sub-accounts or envelopes for different saving goals. Utilize these to visually track progress and prevent borrowing from one goal for another. Automation is your financial superpower. It builds discipline, eliminates emotional decision-making during market fluctuations, and ensures consistent progress towards your goals, even when life gets busy. The biggest enemy to long-term wealth is often our own behavior. Avoid panic selling during downturns. The market always recovers, rewarding patience. Historically, every major bear market has seen a recovery. Chasing hot stocks or market trends rarely outperforms a diversified, low-cost index fund. For example, the S&P 500 has averaged 10% annual returns over the long term. Conduct an annual financial review. This is your personal board meeting. Check your net worth, review goal progress, and adjust your budget or savings rates if needed. Life changes, marriage, children, job shifts. These require portfolio adjustments. For instance, having children might shift your focus to 529 plans or increased life insurance coverage. Your financial journey has been about taking control. From understanding your starting point to building a robust foundation and optimizing growth. Now, it's about sustaining that momentum. Here's your action plan checklist. 1. Assess your current asset allocation. Use online tools or a financial advisor to determine if it matches your age and risk tolerance. 2. Implement automatic contributions to all investment accounts. Increase contributions by 1% annually, aiming for maximum limits like $23,000 for 401ks in 2024. 3. Set a rebalancing schedule semi-annually or annually. Most platforms offer tools for this. Consistency is more important than perfect timing. 4. Conduct annual financial reviews. Use tools like Personal Capital to track net worth and spending. Make adjustments to your plan based on life events and market performance. Timeline quarterly, check automated contributions are active. Biannually, review allocation for rebalancing. Annually, a full financial health checkup, including insurance and estate plans. Resources, reputable robo-advisors, Vanguard Digital Advisor, Fidelity Go. Educational platforms, Investopedia, NerdWallet. Certified financial planners, CFP Board website for complex situations. Your financial future isn't a mystery, it's a blueprint you've learned to draw. Every step, from recognizing procrastination to automating your portfolio, builds a robust path. Take action. The inertia of inaction is the silent destroyer of wealth. Don't let another day pass without setting up those automated transfers or reviewing your allocation. The greatest gift you can give your future self is financial independence. It's the freedom to choose, to pursue passions, and to live without the constant weight of monetary stress. This isn't about getting rich quick. It's about building wealth slowly, deliberately, and sustainably. It's about optimizing your journey, not just reaching the destination. So, embrace the power of optimization and automation. Your future self will thank you for the calm, consistent path you've laid. The journey to financial self-sufficiency starts now.